The aftermath of the U.S. government's takeover of Silicon Valley Bank, SVB, last Friday is causing ripple effects in the global economy. SVB, which was primarily serving startups and the tech industry in California, was the 16th largest bank in the United States and the biggest bank failure since 2008. Signature Bank in New York was also closed down by regulators on Sunday. In contrast, Canada has not experienced a bank collapse in almost 27 years, although there is still a risk of bank failure. The Canadian banking sector differs from SVB's circumstances, making it less susceptible to collapse. However, no bank is completely immune to a bank run, which could trigger a collapse if all depositors tried to withdraw their funds simultaneously, according to Western University's Christian Bravo, Canada Research Chair in Banking and Insurance Analytics. Silicon Valley Bank, SVB, had invested heavily in government bonds and mortgage-backed securities, which lost value as the U.S. Federal Reserve raised interest rates. While this is a common problem in banking that can be insured against, SVB failed to do so, leaving a gaping hole in its balance sheet that needed to be filled with capital. This triggered a bank run among depositors, leading U.S. regulators to take over the bank. In contrast, the Canadian banking system is better regulated and stress-tested, making it less susceptible to this type of collapse. Banks in Canada must meet rigorous liquidity standards set by federal regulators, and they are generally more concentrated around the Big Six banks. This means that small depositors in Canada are less likely to experience a bank run. Additionally, the U.S. insurable amount of $250,000 is higher than the insurable amount in Canada, which is $100,000. Despite this, the U.S. government guaranteed all SVB deposits, and the Office of the Superintendent of Financial Institutions took control of SVB's Canadian assets.